Good morning, ladies and gentlemen. This morning we are going to host the TD Bankable Series webinar. We're just going to wait a few minutes just so everyone in the attendance can get started. Welcome this morning and hope to enjoy. Good morning, everyone joining this morning. I'm Francisco with the Bronx Chamber of Commerce, joined today with TD Bank, our corporate sponsor partners. This morning, we're going to give a lecture on Bankable Series, one of our part series with TD Bank. We're just going to wait another minute or two just to make sure everyone gets it this morning. Good morning, everyone. So I'm just going to introduce our host today and myself. My name is Francisco Aguilar, and I'm with the Bronx Chamber of Commerce. I'm joined today with our corporate partners, TD Bank, representatives Marcus Gonzalez and Radimus Alvelo. Today, we are going to be able to give a presentation, part of our TD How to Get Bankable series, and establishing and fixing business credit today. I want to turn it over to Marcus firstly. But again, I'd like to thank TD Bank and for all you guys do for us here at the Chamber, and looking forward to the continued partnership for years to come as a corporate sponsor. So Marcus.
Awesome. Good morning, everyone. Francisco, can everyone hear me?
I can hear you.
Awesome. Perfect. So good morning, everyone. Marcus Gonzalez, Community Business Development Officer for TD Bank in New York City. My colleague and partner, Ray, is on the line, but he's having some technical difficulties. So if you guys can see him, he says hello. If not, we'll continue with the presentation as we had planned. So just wanted to share my screen really quickly. Just give me 1 second to do so, and then we can get the ball rolling. Awesome. So I can't see you guys, so I just want to make sure you guys can all see the screen. Francisco, if you can give me a yay or nay, can you see the
Yeah, you're
screen
good,
properly?
Marcus. You're good, Marcus. Just before you
Awesome.
start, I just want to say, if anyone has a question or a comment or something that they want Marcus or Ray to comment on, feel free to leave it in the chat. I'm going to be monitoring it today. So if you have a question, feel free to put it in. That way, after the topic, I can get Marcus or Ray to answer the question.
Awesome. Thank you. So we'll jump right into it. So today's topic is business credit, how to obtain it, how to maintain it, and just some basic understandings of it. So today, for our learning objectives, we're going to go over, we're going to examine credit scores, how the reports impact financial opportunities, how businesses obtain it, maintain it, and repair credit, what is credit actually, what criteria do lenders use when approving loans, what information is needed to determine credit worthiness, and just more basics around the credit score. So less than half of small business owners who apply for credit get the full amount that they requested. This forces many owners to use their personal funds to support their business operations. And this is something that we've seen very often where a small business owner would use a lot of their personal credit to start up their business, and that's typical of a lot of small businesses. So there's nothing wrong with that. So we'll jump right into it. What is credit? So credit is just another word for a loan, right? When a business enters into an agreement to borrow money from another entity, and in most cases a lender, that business is using credit. Many different types of credit options are available to businesses as well, including business credit cards, lines of credit, term loans, and determining the type of credit that's best for you involves assessing whether your needs are short-term, long-term, the amount of money that is needed, and a few other factors. But it's really key to have discussions with your financial partner, whether it's a banker, if you have a CPA or a bookkeeper, just having those conversations so that you can understand what your use for the funds, the line of credit, the term loan, and those things are going to be. So, whether it's you're trying to get startup costs, you're trying to purchase equipment, acquire an inventory, or you're just trying to cover cash flow deficits that you may have, those are some of the reasons why you would need credit. And Francisco, you can jump in at any time if there are any questions that come up. And if not, I'll just keep moving along.
Yeah, Marcus, you're good. Don't see any questions yet.
Cool. What criteria do lenders use when approving a loan? So typically there are 5 C's to any type of credit analysis that's done, right? The first is character, which basically refers to you as an individual, your history of delivering on your financial commitments. Capacity, your current and future ability to pay your loans based on income or revenue or future financial projections. There's capital, any funds that you've personally invested into your business and the value of your business assets versus its liability. So, a lot of times people want to get 100% financing, and that's not something that's typical in any situation, especially with the way the economy is in this day and age. Lenders or anybody that wants to back you is going to want to see that you have some skin in the game as well. That's why up on the screen, it says put your money where your mouth is. They want to make sure that you believe in your business just as much as you want someone else to believe in your business, that you want to invest in your business. Collateral. That includes assets belonging to you that a lender can seize if for some reason you go into default. So that's not the first priority of a lender, right? The main issue is to get repaid. No lender wants to take over your assets and then look to sell it somewhere so that they can be made whole. So that's like the last step in being made whole in a loan, is to collect on the assets that the business has. So that's not something that should deter you from applying for a loan, but that's just something that you should be aware of when you are applying for a loan. The conditions, right? The conditions are basically the external factors such as the state of the industry, state of the economy, as well as what the purpose of the loan is for. So if you are in an industry that is unfortunately declining, That's something that's completely out of your control, but that can play a huge factor in whether or not you're able to obtain financing from any lender. So what information is needed to determine credit worthiness, right? So there's a lot of different information, and depending on the lender or where you go to obtain financing, they may have different requirements. So when you apply for a loan, the lender will request information that they can use to assess your credit worthiness. Different lenders will request different documentation, and some lenders require a lot more than other lenders. Typically what we see is the more money you ask for, the more documentation the lender is going to ask of you. Audited financial statements provide much more assurance than, let's say, tax returns, but audited statements can be very costly and it can take a lot of time, and not every business is not every business wants to have audited financials, and not every business needs to have audited financials either. It's dependent on the industry, dependent on the business, and dependent upon what dollar amount you would be looking for as well. So business plan is key. That's something that every business should have, regardless of what their position in their business life cycle is. Financial statements, that's something that's very key, not just to have, but to understand, so that you know how your business is operating. You can understand the ins and outs of the cash flow. Maybe you can make some cuts in some areas rather than others so that you can have more cash flow available. Bank statements, that's something that can easily be generated from your financial partner. Your resume of you and any business principal that you're looking to have in your business. And this is just going to show the potential lender what your background is. Do you have a history in this industry, running this type of business, or is this something that's brand new to you? And that's going to play a huge factor as well. A list of assets, that's something that's huge to have also, just so not only that the lender knows, but that you have an idea of what your company has as an asset as well. And then the last thing is, the last thing is the legal documentation. And that's basically the information that you would have when you start your business. You know, the state filing receipt, the articles of incorporation, the articles of organization, whatever documentation you acquire to start your business, that's something that the lender is going to want and need as well. So going a little bit more into it, what is a credit score? And a lot of people know credit score as the FICO, which stands for the Fair Isaac Corporation. And that's the most widely used credit metrics, just because it's one of the first ones that came out and it was kind of commonly adopted. And that ranges generally between 300 and 850, but some industries can go a little bit higher depending on the industry. So the auto industry or credit card industry, for instance, they can go from 250 to 900. But again, it's the FICO is the most generally accepted, but there are other examples of credit score as well. I know personally on my credit card, there's an option that you can look at your credit, and it's not the most widely accepted ones like Equifax or Experian or TransUnion, but it's my personal credit card's credit metrics that they use, and that score is going to differ from what I would get from the Equifax, Experian, or TransUnion. Now, business credit score is calculated a little bit differently, and it's also used by different businesses. So the most popular business credit criteria programs are Dun & Bradstreet. Experian and Equifax has some business credit score criteria as well. And those range from 0 to 992, depending on what the business is. Lenders will likely look at both your business and your personal credit scores when evaluating your application, and it provides your lender with a rating of what your credit worthiness is. So the higher the number, the more likely it is that you're going to pay back your loan on time. If a company has never applied for credit, you may not have a credit score, and that's something that we see on the business side and on the personal side. I've heard this so many times in my life that no credit is just as good as bad credit, because there's no history to show that you can and will pay back whatever potential debt that you're looking to acquire. And that's, it's kind of, some people view it as good not to have any credit because you don't owe any money, you don't owe anybody, you pay all of your bills in cash, and that may be good for some people, but in the long term, if you are looking to make larger purchases, it is beneficial to have good or at least fair credit. Starting a positive credit history may make it easier to obtain higher credit in the future as well, and can even lower your interest rates. And in some institutions, some instances, when you're applying for a job, they can also look at your credit score as well, and that can positively or negatively impact whether you are eligible for a job or not based upon your credit score. So up on the screen, it just shows you some of the different examples of credit score, where you might get the different ratings and all of these. So the 726, the 698, and the 711 can all be done on the same day, but it's just the different businesses that you go to obtain the credit score can have a different credit score rating. So just something to keep in mind when you guys are thinking about not just your business credit score, but your personal credit score as well. Some factors that affect your credit score: payment history, the amount that's owed, the length of credit history, new applications, and types of credit. So all credit score calculations depend on the detail of your credit report. They consider some of these key factors that are on the screen. Late payments adversely affect your credit score as well, and it can do so for up to 7 years. And inquiries, so new credit applications affects your credit score about 10%, just because if you apply for a lot of different credit all at once, then that can negatively impact your credit and would lower your credit score, depending upon how many times you do it, what's the time frame that you do it in, and those inquiries can stay on your credit for about 2 years, but they're only supposed to affect your credit score or be a factor in that for the first year. So payment history, try not to make any late payments if you can. What I do personally, I set up a calendar reminder at least 5 days prior to when my payment is due, just because I don't like to do auto payment. So I set up a payment reminder at least 5 days before my payment is due. That way I know, ABC credit card company is due on such and such date. I'm ahead of the curve. I can make a payment prior to when it's due. The amounts that's owed. So typically you want to stay below 30% of what your available credit is. So let's say you have overall business credit of $100,000 available to you in a line of credit, right? You want to be under $30,000 of outstanding balance on that line of credit that you have available to you. That way, the creditors and the people that are looking at your credit score know that you do have some availability that's left, and you're not going more into debt than you necessarily need to be. The length of time of your credit history. So if you don't have any credit, it's just as good as having bad credit. And if you have an old credit card or credit profile on your credit history, try not to close it out, because then that shortens the credit history, the length of credit history that you have, and that can negatively affect your credit score as well. Cool.
Marcus, we actually got a question here, if you don't mind answering this. Seems like a good question. How does this work? I'm assuming they mean like business credit when applying for business credit cards.
So business credit cards are typically using more of your personal credit history, especially if the business is fairly new. They'll look at your personal credit history to see what that credit score is, what your history is, and they'll kind of go into depth on your personal credit. And a lot of times, and not every institution, but a lot of institutions require the personal credit, the business credit, to show up on the personal, the individual's personal credit score. I have seen that a lot. So that's something that you want to be mindful of. But the business credit card is typically, the approval or denial is typically based on the individual's credit score.
Awesome. Hope that answered the Sarcini's question.
So there are a lot of different ways for you to check your credit score. Some of the ones that are most commonly used are up on the screen, and I know that there are others as well, but these are the ones that are most commonly used and accepted. So annual credit report, you get, one free copy of your credit annually. And then you can go to the other websites, the Equifax, Experian, TransUnion. You can call them, you can go to the website, you can do a lot of different things with some of the different credit companies that are out there as well. So this is just some general information for you guys to keep, to have, if you don't already know it. So there are many reasons that somebody can have trouble getting approved for a loan, right? So we already discussed that new businesses tend not to have business history. So they don't have that solid financial history, or you lack the documentation to convince a lender of your credit worthiness. So they may have difficulty getting approved for a loan, as well as you may have a low credit score based on some external factors that you may not be aware of. So SCORE is a nonprofit, is another way that you can obtain credit information about your business, and you can also go there to try and repair your credit as well. It's a nonprofit organization that partners with the SBA and offers free mentoring services to small business owners. That is a huge one. CDFIs are another way that you can get help with your credit as well. CDFI stands for Community Development Financial Institution, and typically they are nonprofit organizations that are government-backed organizations that provide financing and business technical assistance to borrowers who may not qualify for traditional lending. And then, of course, the SBA, the Small Business Administration. It's a government agency that offers a variety of loan programs suited to different businesses and different business purposes. And they can typically, they say 75%, but it's typically about 50% of the loan that the SBA will guarantee. And that makes it a lot easier for certain businesses to obtain financing if they may not have the collateral to back up the full amount of the loan that they're requesting. The SBA can come in and help out with that as well. And then, of course, pay the bills on time, try not to get close to your credit limit. I mentioned before, staying below that 30% of the total availability that you have. If you have high credit limits, that's good, because they're going to use that ratio of total availability to what you have outstanding. And if you have more available than what you have outstanding, that is going to increase or help to increase your credit score. Don't close out your oldest credit card debts. We touched on that a little bit as well. And it only applies for new credit card accounts, or new credit accounts, not just credit cards, but new credit accounts if you absolutely need them. Opening a lot of accounts or doing it in a short period of time is a red flag to lenders. And when they pull the credit, they can see the amount of applications that you've applied for, the time frame in which you've applied for them. So definitely be mindful of that as well. And of course, fact check your credit report. Always go in and check to make sure that the information that's being reported is accurate, whether it's an account or a late payment or a delinquency, or just it's always good to at least a couple of times a year, if not just once a year, just go in, check your credit report, run through it, make sure there's no discrepancies on it. And then if there are, you can go to some of the agencies that were listed here to kind of dispute them directly.
Marcus, we got another question from Jessica. Oh,
Yeah.
I'm sorry. Could you establish business credit without your social security number?
I'm going to say no. Some institutions are, so for a traditional bank, no. There are some institutions that are able to do lending for an individual that's not a citizen or a naturalized individual, where they have a social security number or an EIN number. There are some institutions that can do that. And I'm trying to think of some of them off the top of my head right now. I think Ascendus may be one. I think Next Street may be another. There are a few organizations which are CDFIs, that Community Development Financial Institution, that can lend to an individual that does not have a social security number. So there are options for it. So, don't just think if a bank doesn't do it, no one is going to do it. There are a ton of different options and a ton of different ways to get access to capital. And it doesn't necessarily have to be just with a bank. So traditional lending, no, you cannot do it without a social security number, but there are ways to get access to capital without a social security number, yes. Good so far?
Yeah, that was all the questions for now.
Cool. So there's no magic formula. Just kind of follow the rules and stick within your limits. Try not to be overexposed. And there's a few different programs and presentations that we have at TD Bank where we can kind of talk about understanding capital and understanding the financial statements so that you may not get into some of these issues with having bad credit or being overexposed on your credit. And Francisco, you can correct me if I'm wrong, but I think we can look at doing some additional presentations in the future. And if there's some specific needs that the audience has that we can address, then we can look to tailor a presentation based around, the most popular need and things like that. So next step for you guys, look at some of the resources that we have with some of those financial education information. You can go onto the website yourself. There's self-taught courses, or you can speak to Francisco and the Bronx Chamber. And I guess, Francisco, I don't know if there's like a poll or a suggestion box for different topics that they would want to see in the future. But, whatever process that is, we can definitely look at facilitating programs in the future. But these are just some options that people can go to look at business and consumer credit, and also the financial education programs that TD has as well. So thank you, everyone. On behalf of Ray and myself, Marcus Gonzalez here at TD Bank, thank you for your time. If there's any questions, we can continue on and answer those as well.
Yeah, we actually got some questions here, Marcus, at the end. So let's see here. First up is from Mel Jones. That was in our Q&A section. It says, for business credit, is it best to pay off a card monthly or carry a balance in order to build the business credit?
So that's a question that we get pretty often. And I think it depends on the business and the business where it is in the life cycle of the business. So if you're trying to establish credit and you don't quite have good credit just yet, I would say keeping a small balance is good. Just make sure you're not above that 30% that we, commented on earlier. But at the same time, if your business is at a different point in its life cycle where you already have credit and you're just trying to maintain the credit, then paying it off in full if you can be beneficial also. That way your availability on your credit is higher, and that can positively affect your credit score. So that's a question that we get all the time from the personal side and the business side. And I think it really depends on where you as an individual or where your business is in its life cycle and what you're trying to accomplish with the credit need.
Awesome. We got another question, or more of a question from JuanAdorno. He says, hi, Marcus. He represents a few dozen minority businesses via consulting. And he wants to know if he can follow up with you with his client on behalf of his clients in terms of financial needs, and was looking to get your emails. Maybe if you want to leave that in the chat, just for everyone in the audience to get, if they have any questions in the future.
So just, I think I made an error in the beginning. I jumped right into the presentation and didn't even fully introduce myself. So again, Marcus Gonzalez, Community Business Development Officer for TD Bank. I've been with TD going on 18 years now, in a variety of different roles. I started with the bank as a part-time teller, customer service. I was an admin. I was a credit analyst. I was a commercial lender. And now in my role as a Community Business Development Officer, I work with a lot of nonprofit organizations, a lot of community-led organizations where trying to bridge that gap of the community and the big bank, right? So TD is a fairly sizable bank. We're number 6 in the country, especially now with acquiring First Horizon, which will take place in the next year or two. but trying to bridge that gap between the big bank and the community so that there isn't a hesitation to walk into your bank and have a sit down with your local banker and say, this is what I'm looking to do. What do you think is the best option? What are my options? What are my steps that are necessary to do so? So having these conversations with the chambers, speaking to you, and speaking to the chambers is probably the best way that we can connect more so with the local business owners more than a one-off, because the one-offs are hard to come by. I'm one person. There are hundreds of thousands of businesses that are out there. I can't reach everyone individually, but if I can have a one-off conversation with somebody, that's great. If I can reach a larger audience through one of the chambers or another organization that has a larger touch point, then that's great. But yes, that's my email. If somebody wants to reach out to me and have a sit down, have a conversation, I'm 100% open for it.
Awesome. Yeah, and I just want to go on behalf of the chamber and speak a little bit of good about TD. As I mentioned earlier in the presentation, TD and the chamber are corporate partners together. I know recently we've been putting on a few different webinar series, including this financial building blocks one, but also the idea of us, the chamber and TD Bank really connecting at a greater level, as one of the benefits of being partners together is that we've been able to put on a little State of the Union or a State of the Bronx address, which gave both the branch managers of TD Bank as well as the Bronx Chamber an opportunity to connect. So I want to be able to say that, as Marcus alluded to earlier, giving us suggestions if you have any for TD to cover in the future, just what you would want to hear from them for us to host in the future. I got another question in the Q&A as well. Can you speak to how often to check business credit and the cost?
So there are free options. So if you are going to someone that's going to charge you an absorbent amount of money, I would not recommend that off the bat. There are a ton of free options that you can utilize. The city and the state have a ton of resources through various organizations that are run by the city and state that can help you. And yes, someone may have more expertise and they may charge a fee for their expertise, and that's fine. I'm not trying to, knock anyone's hustle, but there are free options for access to that information. So how often? If you're looking to apply for credit, I would say definitely check your credit score a couple of months prior to, but checking at least once a year can't be harmful. That's the free route, the once a year. But if you want to check it more often than that, then I check my credit pretty frequently. But personally, I've had some issues where my credit was compromised, and now I'm a little bit nervous about it, so I'm checking it on a regular basis. And that's just me personally. But at least once a year. But if you're looking to obtain credit, then a few months prior to actually applying for the credit is good. That way, if there's anything that comes up on your credit, it's not a surprise to you. So when you go to apply for that loan, the banker isn't going to say decline because you had a delinquency, 2 months ago, and you didn't even know about it because you paid it. Oh, that's something else as well. So if your bill is due on the 1st of the month and you pay it on the 30th or thereafter, you get the first 30 days as a grace period, but 30-day plus, you get reported as delinquent, but they don't, on the 31st day, they don't report you as delinquent for 1 day, they report you as delinquent for 31 days. So they go back to when the payment was originally due, and that's when they calculate how late the payment is. That's something that just came to my mind as well. But so check your credit as often as necessary, but at least once a year. And if you're applying for credit, then a couple of months prior to that actual application is submitted.
And another question here. It says, I bank with TD for business. Would I still need to provide all of my documents again if I apply for a credit card?
Yes. So as a TD employee, I know that the credit card department is separate from the business lending department, and it's separate from the personal lending department. So while it's all one bank, they are separate departments. So it is beneficial if you want to move speedily to provide that information at the time that you're looking to submit the application. And It may seem redundant, it may seem like a hassle, but it is something that is necessary. Even if you bank with us, sometimes people come in and they say, I bank with you guys for 10 years now. You can look at my banking history. I deserve to be approved for a loan, but there are other factors that go into that. So long story short, yes, if you already bank with us and you have a credit card, but you're applying for a personal loan or a business loan, you still would need to provide that information. And again, the more money you request, the more documentation the bank or lender is going to ask for.
One other question, what's the difference between credit card and a credit line?
So they are pretty similar. So let's go back a little bit. A term loan, a line of credit, and a credit card. Those are the most common ways that you can obtain financing, right? So a term loan is one lump sum of money that you get at the closing. Once that money goes out the door, you don't have access to it again. And on a monthly basis, you're required to pay principal and interest. A line of credit is revolving. So at closing, if you don't take any money, that's fine. The total amount that you are approved for stays there. And then you only pay interest on the amount that you have outstanding. So if you have a $100,000 line of credit and you only use $10,000 for a month, then for that month, you're going to get $10,000 worth of interest. Whatever that interest rate is, you're only being charged interest on the $10,000, not the $100,000. A credit card is similar, right? It's revolving. You only get charged interest on the amount that you have outstanding. Credit card rates are higher, and that's because you have more. Well, one of the reasons why that is because you have easier access to the funds, because the credit card, it's a card, right? You can take it wherever you go, you can swipe it here and there, and you have more availability of it. Whereas the line of credit, you get checks to use for the line of credit. You can transfer the money to your account where you can use it there, or you can pay directly from the line of credit, like via wire or ACH or things like that. But line of credit and credit card are very similar. Credit card tends to have a higher interest rate. And I think also because the ease of accessibility of it, and it's a little bit easier to be approved for it because it uses more of your personal credit rather than the business credit, where a line of credit would look to that as well.
Yeah, Marcus, I was just going back with Ms. Jessica Brewington about the CDFIs and the lending options for those without or those who want to create a business profile without their social security number. Those lending options are from CDFIs, correct?
Yes. A traditional bank is not going to lend to an individual that does not have a social security number. Also, if you are looking to establish credit, a great way of doing that, whether it's on a personal side or the business side, is a cash secured facility. And that may seem counterintuitive. Why would I ask for money if I already have the money that I need? But if you're looking to build your credit, you can establish a cash secured facility, and that is going to help you build your credit. And then as your credit gets better, then you can look to modify and release that cash security. But that's another way for you to obtain credit as well if you're trying to build credit.
Sure. That's all the questions I see for now. Not sure if we have any more coming in. But again, I just want to thank TD, Marcus, and Ray for your participation today. Actually, just see another one coming through in right now. Let's see, cash security as in secured credit card. That's from Jessica.
Secure credit card. Yeah, you can secure a credit card. You can secure a line of credit. You can secure a loan. You can, as long as you have the cash to do so, you can secure it. I don't know if every institution offers it. I know, speaking for TD, because I work at TD, I know that that's something that we offer. And I don't think a bank is going to turn down taking your money. So I would say that another institution would offer that as well. But I know for a fact that TD does, and I'm sure other institutions do as well.
I see another question came in. If you have a limit of $2,000 and we utilize $1,000 to pay it, but pay it off in full, does it count against us since we are more than 30%? Do you understand that question?
Yeah. So that's 50% of your exposure, but you're paying it off in full. And are you doing that on a monthly basis? Like every month you're paying off the full $1,000? I don't say that's going to count against you as much as it may seem, because you're above that 30% of outstanding. But you may be, if you're now trying to establish credit, you may be hampering the credit profile from being developed by not having any credit that's outstanding. So if you're paying it off every single month, you're not building a credit history. They don't show a history of, like having a balance and paying it off, having a balance and paying it off. So you may want to pay it off in full because you don't want to get charged any interest. And obviously that's the most important thing, right? You're trying to save money. You don't want to get charged money where you don't need to, but the credit card companies want to see that history there so that they can show that, or they can see that you are able to pay it back. You have a good track record, and that's what's going to help your credit score as well. But I don't think it's going to hamper it that much if you are at 50% and then you pay it down in full. But just be mindful of if you want to build credit while utilizing that payment method. And I know I keep using 100,000 as the number. I know not everybody has $100,000 of credit, but that in my mind is easy math for me to do when I'm thinking of the 30% population.
We're getting great responses from the people who are asking questions, so it's good to see everyone getting some information this morning. Just send in any last minute questions if you have them. I know we're winding down in the time here, so just want to get those out of the way. If you guys have any last minute questions or comments.
And yeah, I put my email in the chat if anyone needs it or has it. I can put my I can share this back again. Yeah. So Ray's located in Queens, but he covers the Bronx as well. I'm in Madison, now one Vanderbilt. So I'm in the city, and TD is open and operating, and we have a ton of locations in the Bronx. So if there's any questions or interest, my email is incorrect there. It's Marcus.Gonzalez, not Marcus_Gonzalez. So let's take that down and just use the chat one that's there instead.
I got you, Marcus. I put your email there again, just in case if anyone missed it the first time.
Thank you.
We got a pretty specific question I see from Sarah C. Sorry if I'm mispronouncing your name. Would you suggest for a bookstore a credit card or a line of credit?
So one of the reasons why a credit card is easier to obtain than a line of credit is because there's no real ask for collateral, right? So when you're looking at a line of credit, they're going to look at you as an individual, they're going to look at the cash flow of the business, and then they're going to look at the collateral that the business has. So in the bookstore case, the collateral is going to be the actual books that are in the bookstore. Now, again, no institution is going to want to have in this case, books that they have to go on the street and sell to be made whole. So the advance rate that they're going to use, the value of the books is going to be discounted. So if you have, again, for a lack of better number, $100,000 worth of books, they're going to give you $100,000 worth of a line of credit based on the value of those books. They're going to discount that amount maybe to 40% for inventory, right? So account receivables is another collateral method that's used, and that is typically 75 or 80% of the value is what we lend to that number, right, for account receivables. For inventory, which is what the book so would be considered as inventory, it's typically about 35 to 40% of that value. So if you know that you have $100,000 worth of books, you are probably going to be in the range collateral-wise of a $35,000 to maybe $40,000 line of credit, assuming the business cash flow-wise can support that amount of debt. So there's a lot of different factors that you want to consider, and that's why having a conversation with your financial advisor is key, right? So you go into a bank, you apply for a loan without having a conversation with anybody, apply for the wrong type of facility for your need, then that can adversely affect the outcome of the decision as well. So you have a conversation with your financial advisor and you lay out everything that you have, everything that you're looking for and what the purpose is, then it can guide you in the right direction. Maybe, you know, if you have a lot of assets in your company, you have a lot of books, you have some high quality books, you have The Alchemist on the shelf, which is my favorite book, then that may be of high value, right? And your inventory amount is going to be higher than lower. So even if they use that 40 or 35% advance rate, you can still get a sizable line of credit. If that's not the case, then a credit card, and if that's not the case and you have good personal credit, then a credit card might be the better option. The interest rate might be a little bit higher on a credit card, but you'll have more flexibility in it, and that's going to help build your credit. So in the future, if you want to go for a line of credit, you may have a better chance at it.
Awesome. I think we're gonna all invest in a bookstore after that. I'm gonna put Alchemist on the shelf too. I love that book. Well, if there's no more questions after that, I think that's a perfect way to wrap up today. Let us know last minute calls, anyone if they have any. But if not, again, I'm Francisco, membership manager here at the Bronx Chamber of Commerce. If you have any questions regarding the chamber membership, I'm the person that you can go to, as well as Marcus and Radamus from TD Bank. They are some of our greatest partners here at the chamber. So we love going back and forth with them as well. So with that, I want to wish you all a great rest of your day. And thank you for joining us this morning as our part of our TD Bankable Series.
Awesome. Thank you, everyone. Francisco, have a great day.
You as well, Marcus. Thank you.